eRevMax Hotel Sentiment Outlook states that optimism is by and large cautious across regions, but its level varies sharply region-wise. The Hotel Sentiment Outlook for 2021 published by eRevMax, a distribution technology provider for the global hotel industry, has indicated the business sentiment as the highest in the Middle East region and the lowest in the European hotel market. In the wake of the second wave of the pandemic reported in Europe, the hotel industry sentiment outlook for 2021 is at the lowest ebb in the continent. The level of optimism is by and large cautious across regions, but its level varies sharply region-wise. Europe has been the most hard-hit regions, with occupancy falling sharply after the second wave of the pandemic, whereas the Middle East market has improved the occupancy consistently over the last few months and continue to outperform other regions, the survey notes. As per the eRevMax Hotel Sentiment Outlook, while the sentiment of the Middle East industry is 4.11, it is 2.77 in the European industry, with other regions like Africa, 3.43, North America, 3.27, Asia Pacific, 3.12, and South America, 3.00, falling in between. As far as expectations about the time required for the market to recover and reach the pre-COVID levels, the industry is largely divided. However, around 40% of the people participating in the online survey expressed the sentiment that the global industry will take 2 to 3 years to reach the pre-COVID levels of business. While short-term recovery has been witnessed in some regions, by and large the hoteliers feel that the recovery would take longer, possibly by 2024. The hotel industry will be looking for new technology adoption to improve sales and the revenues. Hotels will be prioritizing online sales to drive demand, even as they understand the growing importance of contactless, smart technology in post-COVID world. However, there will be differences in the way each region will be looking at technology. While Channel Manager and the booking engine will remain top priority in Europe and Asia Pacific, in North America, hoteliers are likely to invest in central reservation systems. The second wave of coronavirus has pushed back the recovery of India's hospitality industry further, and the sector may see a return to pre-COVID levels only by 2024, credit rating agency ICRA has said. ICRA continues to have a negative credit outlook on the Indian hotel industry. Only 31% of the rated portfolio have stable outlook as of June 2021, compared to 92% in the category in January 2020. The pickup in demand in first half of 2021 was largely led by leisure travel, staycations, wedding and higher food and beverage revenues. ICRA stated that some business travel in specific sectors also aided the recovery. With demand and occupancy declining severely in Q1 2021 due to cancellation of several events and travel restrictions, revenues are expected to witness a drop of 50 to 55% on quarter-on-quarter basis, although the decline would be lower than Q1 2021, which was marred by the pan-India complete lockdown. Demand slowdown has significantly impacted Q1 2022 occupancy and average room rates, although it is better than Q1 2021 levels. As against a 10 to 12% occupancy witnessed in Q1 2021, it was higher at 26 to 28% in Q1 2022, with demand in May 2021 largely coming from quarantine business for mild COVID-positive patients, wherein the hotels entered into formal contracts with hospitals chains. Pan-India average room rate was at 3,600 rupees to 3,700, about 8 to 10% higher on year-on-year basis, although the demand slowdown has impacted average room rates since the onset of the pandemic. It is likely to remain significantly lower than pre-COVID levels through FY 2022, in the absence of adequate demand. Q1 2022 revenue per available room 2 stood at a 65 to 70% discount to pre-COVID levels. Discounting in the market is inevitable with such a drastic fall in demand, and hence the recovery is expected to be occupancy-driven. The ratings agency expects permanent closure of some smaller hotels, leading to consolidation in the near to medium term. ICRA's industry sample is expected to report operating losses in 2022 as well, although it will be lower at low single digit, compared to the 23% operating loss witnessed in 2021. Hoteliers have cut costs significantly, including redeployment of manpower, outsourcing of non-core activities, centralization of business functions, and automation of certain processes. Some of these will be permanent and will aid in the reduction of break-even levels. The government's announcement of the Emergency Credit Line Guarantee Scheme in the last week of March 2021 is expected to further bolster the industry in meeting the operational and financial commitments in the medium term.